Well, welcome everyone to today's webinar. Got a great one for you. Very excited to have you all join us today. Lots to talk about, so we will get into the material here very quickly. I do want to thank everyone for sending in your questions ahead of time. Definitely helpful with with the material and the pieces that we'll cover, and also, we update our blog and podcast every week, and we'll cover some of the additional questions that we're not able to cover during today's webinar on the podcast as well. So check out our one of our future episodes on that. So let's talk about the markets. This is our quarterly investment commentary, and a lot's happened this year. We've had some volatility in the markets, and that's not uncommon. That is something that that we see on a regular basis. It's actually less common to not have volatility, but it is in our face every single day, and it does, cause concern when you see markets do what they're doing. Well, here are several different asset classes. These are all equities, stocks. There's a commodities basket here represented by this red line, and then also a real estate one that's included that looks at what are called real estate investment trusts, which are publicly traded companies that invest in commercial properties, things like that. There's actually, though, some interesting things to point out. The best performing asset class, and this was as of a couple of days ago, was international markets. They were up nearly 7% for the year, and if we were to annualize that, they'd be up almost 24% by the end of the year. If this type of performance were to continue, whereas the S&P 500 is down 12%. Is down lower back in early April. But again, this was as a couple of days ago. Markets have bounced since I've put this graph together, but did want to just kind of show. Well, if that performance were to continue, the S&P 500 would be down 35% for the year, and then the Nasdaq, which is more tech-related stocks, down 15% at this time, annualizing at down 41%, and then small company stocks down 17%, and that would be annualizing at a down 46. So, not to say that this is going to continue, but it is important to recognize why we're diversified. I mean, even this, just looking at the breakdown between different types of stocks. I mean, international stocks are up this year, whereas small companies and tech companies, they're down that significantly and on track to have a very bad year should this continue. So, that's the power of diversification when it comes to the portfolio and the construction around portfolios. It's easy to get kind of sucked in to wanting to invest in the best performer, and especially something that's been performing well over the last 1 or 2 years. And it just, that doesn't, you can chase those things, and sometimes when you chase them, they continue to go up, but they also can be more volatile. And I have a slide here that I'll show kind of explaining that. Here are sectors. Again, different types of stocks, different companies based on the type of industry they serve are performing differently. So we have consumer staples, which is this blue line, XLP. That's the ETF, the basket that represents the consumer staples index, up 3.7% for the year. And then the other positive asset class this year was utilities. So that's not surprising. And part of the reason is because, well, if you think about, well, what could the tariffs create? Well, they could create, definitely inflation. They can create a recession, especially if companies are faced with increasing their costs. They may not be as competitive in the marketplace anymore, and they're faced with choices of either reducing their profit margin, which is definitely something that they would consider, but they also look at, well, how do we trim expenses? And salaries are typically one of the largest expenses for most corporations. And if you start to see some weakness in your business, well, then you may start laying off people. And that can perpetuate itself into more systemic layoffs just across all kinds of industries, depending on how bad a recession is or how much a slowdown happens. However, some stocks, they are companies that provide services or products that you're going to purchase whether you have a job or not. Now, you might change the where you shop, or you might move along a quality spectrum if income is tight. But consumer staples, those are companies that you would see in the grocery store, companies that in the healthcare product line, like you're going to purchase Band-Aids, you're going to continue to purchase medicines, over-the-counter medicines. You're going to go shopping at the grocery store. You're going to buy cereals. I mean, people are going to purchase those things that that they need to sustain themselves. And utilities are the same. Those are regulated monopolies essentially, and you're going to continue to pay your light bill, your gas bill, things like that, whether you have a job or not. At least you're going to maintain that much longer than this other asset class, which is the worst performer this year, which is the red XLY. That represents consumer discretionary stocks. So on the other spectrum is consumer staples. Like, they're staples. You're going to buy those no matter what. Discretionary, well, that is spending that is not required. So a way to think about that is you may not upgrade your phone to the latest and greatest edition if your existing one is fine, if you don't have the income to pay for that. That would be a discretionary expense, things like that. So, and technology is not far behind in in terms of performance for the year on the sector side. Interesting to kind of see that makeup. If you can see real estate here, healthcare is kind of in there as well. So a couple of those are considered more, again, more defensive versus, more growth oriented. Fixed income yields, a lot of attention's being paid to this because it's like, well, if interest rates are decreasing or increasing, that definitely impacts the federal government and their interest expense. Also, it impacts people's borrowing costs, companies' borrowing costs. So a lot of things are tied to interest rates. Here I've got the government bonds represented here by the 10-year yield in purple, 5-year in blue, and then the 2-year in black. One thing that if you've been a long time watcher of the webinars is that you'll see the yield curve is not inverted. So for all of you that don't study this or pay as much attention to this every single day like I do, an inverted yield curve is when the short-term rates, so the black line essentially, would be above the blue and or above the purple, meaning, well, 2-year interest rates are higher than a 5-year interest rate or even higher than a 10-year interest rate. And that's how it's been for the last several years. This would be considered a more normal yield curve, not inverted anymore, because if you think kind of about it, it's like yeah, if I'm going to lend my money to the US government for the next 10 years, I would expect them to pay me a higher interest rate than if I were to lend my money to the US government for the next 2 years, because my money is tied up for longer. There's an opportunity cost. There's more unknowns about what future inflation rates are and even what future interest rates are. If interest rates are going to be higher in the future, and if we knew that, well, then you'd wait until the best time to invest in that, but you don't know. So there's a risk, so to speak, that you should be compensated for. Here's the performance of various government bonds. So the previous page was the yield. So that's just if you were to purchase that 10-year government bond, you'd earn 4.4% each year for the next 10 years, and then you would receive your money back. This graph here is ETFs. So these are baskets of government bonds, and the different baskets represent how long it takes for those bonds to mature. And you'll see here the longest term bond bucket, which is represented here by orange, TLT, is down slightly. And that includes interest rates too, the interest payments that have been received. Whereas the best performer is in the 3 to 7 year ETF, followed by the 7 to 10 year. So kind of interesting, you're seeing in that mid-level maturity some decent performance, and then you've got kind of shorter term bonds which are more stable. You'll see too, this is the other kind of thing I like to always point out with bonds. They don't just, when bonds trade, now if we hold them to maturity, you receive, assuming you buy them at par, you just pay, the base price for them. I mean, you can purchase bonds on the marketplace and pay more or less for them at a premium or discount. That's all possible, but you just kind of conceptually think about it. Okay, well, if I were to just put $10,000 in a CD, I'm going to receive my $10,000 back plus the interest payments that are due to me whenever the schedule of those to be paid are. Well, bonds, though, you can trade them at any time, so they fluctuate based on what the market's doing, and the longer the length of the bond is to maturity, the more volatility you can expect to have with that, because there's more uncertainty with those bonds over longer periods of time. So this is back to my comment earlier about inflation, or about diversification. And I showed this during our previous quarterly webinar, and got a lot of positive feedback on it. And here's what this represents. So if we look here, these columns are, each color represents an asset class. And the very top one is the best performing asset class that year, followed in order all the way down to the worst performing asset class that year. The first two columns here is about a 14-year 2010 through 2024 total return. You can see large cap has had the best performance. But then the next column here is volatility. So that's how much it fluctuates. And you can see where it falls in that line, kind of in the middle. But the reason that we like to show this is twofold. One, just because something did well in a previous year doesn't mean it's going to be the best performer the next year. Like, there's no predictive power to knowing what happened in the past when it comes to these different asset classes. But the other thing that you might notice is I've got a white box with some dots and lines drawn into that, and that represents a diversified portfolio of all these different asset classes. And the reason I show that is because what happens with this white box is that there's an ownership percentage for each of the buckets, I'll show you that here next. And then each year it's rebalanced. So in 2010, REITs were up 27.9%. Those are real estate investment trusts, again, represents real estate. And at the end of the year, cash was just barely up. Interest rates were basically zero, so cash didn't really earn a whole lot. What the rebalancing does is it brings back the percentage ownership, whatever it was at the beginning of the year, and then whatever it changed to at the end of the year, brings them back to the original allocation. You rebalance. So you're harvesting a portion of the profits out of what performed very well, and then redistributing those in the asset classes that haven't done as well. And what that does is that harnesses this volatility instead of being kind of whipsawed by it. Because if you're just chasing what did the best, which if you look here, I've highlighted the orange box, one of the best performing asset classes, but also has a lot of volatility. If you're chasing that, it's highly likely that someone's going to have a hard time holding on to that asset class if they're thinking, oh, wow, 2010, small caps did great. Let's put more money in that. And then in 2011, didn't perform so well. Slightly better in 2012, great in 2013. You can see it's just all over the place. And then so far year to date, down 17% relative to, where everything else is. A diversified portfolio is down nearly 3% for the year. These are the percentages that make up that white bucket. And this is, these are theories and concepts that we utilize to build and construct the portfolios for our clients. The weightings and some of the asset classes aren't going to be exact as what I'm showing here, because each client's going to have a different allocation based on their unique situation. Some of that's driven by distribution needs. How much money do you need to pull out of the portfolio? What's your comfort level with volatility? Are you able to or want to you prefer to have higher returns? Well, that typically comes with more volatility. So, if someone can't handle that or doesn't want that, well, then the allocation is going to be slightly different. So, again, kind of just some education around how this process works. And here I've highlighted that white basket here. So you see, it's in the top portion in terms of performance, but then on the bottom portion in terms of volatility. So you're kind of harnessing this volatility. Doesn't mean it's not volatile, but it does fluctuate, but not nearly as much. But the important piece to it is a diversified portfolio will never be the best performer, because the components, the components are going to each have their own performance. And so unless you have everything in the best performer each year, it's never going to be the best performer, because there's portions of it that are in the second best performer, the third best performer, all of that. But this is what works. It gets people to their destination without running out of money or taking undue risk. Yeah, this kind of definition of a diversified portfolio. And the table highlights the uncertainty inherent in all capital markets, which, again, that's the price for the higher future expected returns, is that there's more uncertainty with stocks. That's, and uncertainty, well, it depends on how you define that. What diversified portfolios have, there's never been a time where diversified portfolios gone to zero. Individual companies have gone to zero. They went bankrupt, but diversified portfolios have not. Another visual representation of the asset allocated portfolio, and then all the other kind of components of the asset classes in there. So now let's kind of talk through the economic data. I know folks like to kind of see where we're at on that. So here with the jobs market, again, very important piece to our economy is jobs. And one of the I think, best leading indicators is that, are we adding jobs here on a month-to-month basis, or are we losing jobs? Yeah, you might hear headlines about layoffs here and there, but it's when the data comes out, what's the aggregate in terms of job creation? And it's been positive. We haven't had a negative month here, uh, basically since COVID, and some of the aftermath with COVID. The previous peak in terms of the job market prior to COVID was 152.5 million people working, and now we're at 159.3 million. Job openings continue. They've been kind of bouncing around here, but I would say being stable here in that 7.5 million job openings range. And this is the previous peak pre-COVID. There's post-COVID, there was a lot of demand for workers, and then that's slowly come down because some of those jobs have been filled. Maybe some people and some companies determine they don't need to fill those positions anymore. A lot of things can change, but we're still at 7.5 million. It's not like that's just completely fallen off the map. So that is what employers are saying. We still want to hire people. This, all these graphs, these are from the St. Louis Federal Reserve, and when you'll see them, these gray shaded areas, they represent recessions. And typically, yeah, you see that really start to drop off during a recession because employers are pulling back. Initial jobless claims, this is another kind of leading indicator related to the jobs market. So this is when people, they get laid off, they're now claiming unemployment, and this is the continued kind of claims related to that. So, longer term unemployed folks. Pre-COVID, there was about 1.8 million claiming unemployment. The peak of COVID in May of 2020, 23.1 million people on unemployment, and then here we are. This is the most recent reading, April 5th, 1.8 million. So in that same kind of line where we were pre-COVID, and that has been, fairly stable for the past several years. Retail sales, this is what folks, they're spending money on kind of retail goods and services, and that's continued to increase. Housing permits, kind of post 0809 when the Great Recession hit, and a lot of that was tied to housing. You can see it really dropped off there and has been slowly building out back. We had that kind of post COVID peak, and then that's come down. But if you kind of look at the trend line, if you were to draw a trend line, you'd see, well, we're kind of on trend. Yeah, it's moving around, but it's been stable in terms of housing permits. So even with the higher interest rates, which that was part of what this drop was initially, as interest rates went up, it hasn't just completely killed it. And that was a big fear during 2022 when interest rates were increasing. This is business spending, kind of peaks here pre-COVID, falls off during COVID, then what we saw, the kind of spike post-COVID, and then steady up until recently. We had slight little spike there. And then now the yield curve. I mentioned that earlier, the yield curve, that is this specific graph looks at the 3-month government treasury. So again, loaning your money to the government for 3 months compared to loaning your money to the government for 10 years. So 10-year government bonds. And anytime the 3-month is higher than the 10-year, this line will be below the black line. And that's gotten a lot of talk here in the last several years, because historically yield curve inversions, when this line drops below the black line, has preceded recessions. See, I've circled them on here. You see there's a recession. Here's the yield curve, recession, inverted yield curve, recession. I kind of hesitate on this one a little bit because there was an inversion and then COVID hit, and it's like, well, not necessarily. I think there's correlation and causation. So I don't think there was a lot of causation there with the yield curve that kind of predicted COVID. But what this is signaling primarily, and the reason this is important, is that lending conditions, when this happens, they're considered to be tighter. It's harder to finance business projects, personal spending, things like that when those happen. And that's why they kind of say that will precede a recession, because when you start to see the lending conditions get more difficult, well, then that can lead to a slowdown in the economy. These last couple of ones, we again, there was COVID here, and then the yield curve inversion that we've had for several years, and now it's uninverted. There's been a lot of Federal Reserve intervention in the bond markets, and I believe that is causing some kind of nuanced kind of situation relative to the yield curve that wouldn't necessarily be the same as it was historically, because the Federal Reserve wasn't nearly as active as they have been over the last since really post 2008 2009. They've been very active in the bond market. All right, let's talk through corporate earnings. This is a very, very important piece to stock prices, and it's because stock prices are a function of earnings. That's just the simplest way to think about it. And the reason I talk about the jobs market is because, well, if corporations, they generate revenue, and here in the U.S., I mean, it's like we are a service-based economy primarily. Yes, there's some manufacturing, but primarily service-based. But 70% of all the goods and services that is represented in our GDP is through consumption. It's what people spend their money on. And if people have jobs, they spend money. That's how it works. And if they don't have jobs, well, they might still spend money for a little bit, but eventually they're not able to continue that, and they spend less money. Well, when they spend less money, that's less revenue for corporations, which then flows through the whole financial statements and reduces earnings. Well, if earnings are reduced, well, then companies might start to think, well, how do we get our earnings back up? Do we need to look at different things to reduce our expenses? And again, one of those being layoffs. Or do we have unproductive business lines, whatever that may be, that can help reduce some expenses and get our earnings back up if revenue is down. And that's kind of where that self-perpetuating cycle is. If revenue starts to drop, earnings start to drop, then companies start laying off people. Well, it just continues. That cycle continues to eventually it stops, and then it comes back around again. What this graph represents here is the earnings per share of the S&P 500. So there's 500 stocks in the S&P 500. They're weighted by market capitalization. So that is a formula that is the share price times the shares outstanding. That gives you the market cap. And the larger the market cap, the higher the weighting in the S&P. And then it takes all of the earnings for each of those companies, weights them to their relative weight in the S&P 500, and gives us then the earnings per share estimates for the entire basket. 2024 came in at 243. That's complete. 267 is where we're looking at 2025, and then 2026 304. And why is this important? Well, this is how future price projections are thought of when you hear people talk about, hey, where do we think the S&P can be in 12 months from now? Well, it's going to be a function of earnings. So what are the estimates at? And these are estimates by analysts that are out there, providing their take on what they think companies are going to earn based on all the analysis that they do. And if we look at earnings estimates, what the market is looking at is the forward estimate. So as we progress through 2025 and we get to the end of the year of 2025, well, the end of the year of 2025 is really based on the next 12 months of expected earnings. That's how the market kind of discounts that in the future. So it's looking at 2026 earnings. So that's why I have 304 here on this graph, because it's 2026 is really, we're looking ahead to the future. And then there's a multiple applied to this. And the multiple is what varies based on investor sentiment, interest rates have an impact on it, but there's no set multiple. It's not like, hey, everyone knows the multiple's always 20 or it's 30 or it's 10. It's different because everyone has a different expectation. And then the collective of everyone determines what the current multiple is. And then if you take that current multiple and you apply it to the future earnings, you can get an idea of future kind of range of scenarios in terms of price projections for the S&P 500. So if we use an 18 times earnings, which has been where the market's been trading at for quite some time, and actually kind of higher than that in the 20 and 22 times, but you can see a future price target of 5,472 on the S&P 500, a 20 times multiple of 6,080, and a 22 multiple of 6,688. So what does this mean? Well, if we use April 21st, the closing price of the S&P 500 at that time, 5,158. Now it's up slightly since then, but that's where it was when I was able to pull this data together for our slides today. At the very low end, and it could, these can change, but at the low end, this is my projection. S&P, and this is assuming kind of things don't go that well, 5,472. Multiples come down when uncertainty rises. That'd still be a 6% return by the end of the year. Now that wouldn't get the S&P 500, it'd still be down for the year, but it'd be a 6% return from now until the end of the year. And on the high end, assuming things kind of revert back to the way they were, by the end of the year, we could see a nearly 30% return from closing value on April 21st, leading the S&P to be about 6,688. That'd put it close to the all-time highs. Because this is, you have to think of this in, if everything was in cash today, if all your investments were in cash, what would provide the best rate of return over the time frame that you're looking to invest? But even if we just kind of think on a very shorter term time frame on 12 to 24 months. And what I'm pointing out here with this market multiple graph is that, or this slide, is that the forward returns on the market on stocks are very good. And I've got some other data that I'm going to show you here, kind of based on some of the volatility that we've seen in forward returns kind of post that. Interest rates, again, as I mentioned, those are a factor that's extremely important to the market. This is the Federal Reserve and the interest rates that they target. They're currently around 4.25%, and year-end expectations. This is through kind of market participants. They have what are called futures, and they put expectations out there, and they use these futures to kind of hedge some risks and things like that. And the majority of current of where the futures market is saying anywhere between 3 to 3.75 by year end. So slight decrease is what the market's expecting on interest rates. Inflation. This is the headline CPI. So it's the Consumer Price Index, and CPI and headline is important because that includes food and energy. Some of the different inflation metrics like core don't include food and energy. But you'll see the different components here, what the colors represent, and peak that we saw kind of post-COVID, and then it's been coming down since, and most recent data point is still continuing to trend lower, which is good, Now let's talk through the tariffs. Got a lot of questions on the tariffs, and I've put together what I think are some good, bad, and ugly scenarios related to the tariffs when it comes to what we'd be looking at related to that. These are historical tariffs. This is going back to the turn of the century of going into the 19th century, Great Depression here, 40s, 50s, 60s, and where we've been now since 2000, more recently. And then now this shaded line here at the very end is the estimate based on what they think the maximum would be. So kind of worst case scenario, and you can see historically where that puts it, kind of where it was in the 30s. So a significant change to where policy's been over the last several decades. So the current state of the tariffs. So you've got imports on tariffs on steel and aluminum, these reciprocal tariffs, the tariffs on Chinese goods, tariffs on foreign-made automobiles and non-USMCA goods from Mexico and Canada, and then automobile tariffs. So, yeah, I mean, one of the things when we think about that is like the market would, because when it was first kind of discussed and announced, the market actually went up because they were thinking, oh, okay, 10% floor on everything in the rest of the world. And then that quickly changed, and that's when the volatility really started to pick up. And yeah, some of these worst case is just having a situation where it's just nothing is getting resolved. I think that is kind of one of the things that the market is just more uncertain. Again, businesses will figure things out. Tariffs aren't necessarily going to be good for stock prices in the short run, depending on again, the sector and industry. Doesn't mean it's going to impact all stocks the same way. As I showed, it's like certain areas of the market are performing fine. Just others are definitely more more sensitive to tariffs. But just having a game plan that is progressing in the right direction is going to be, I think, important for the market to realize. So, yeah, despite there's more worries of recession, labor market isn't indicating any signs of a recession. So that's important to see here, because again, as I've mentioned, it's like the jobs market is very important to our economy. And this graph here on the left, what I've got is the total labor force, and that's, you can see the percentage, and that's the gray line. It's going back, 10 years. Just hasn't necessarily recovered kind of post-COVID percentage of working population working. Now, the number of workers has increased, but the percentage has been stagnant here the last several years. However, look at the blue, aged 18 to 64. So just that group of workers, higher than it's been kind of pre-COVID. And then on the right here, so this is it's a graph that represents two different surveys. So this ISM, that's the Institute of Supply Management, and they do surveys of companies, and they survey manufacturing companies and they survey services companies. And each month they release this report, and they've been doing this for quite some time. And they come up with an index value based on all the survey metrics that they have. And when the index value is below 50, that's signaling that sector, that area is contracting. And when it's above 50, it's signaling an expansion. Well, manufacturing is represented here in blue, and you can see how that, it's bounced up and down here, kind of COVID drop, post-COVID spike. So even though its manufacturing has been below 50, it's showing some slight signs of weakness, but that doesn't just mean the market's going to go down. Services, again, it's had its periods where it's dropped and come back, but that is definitely indicating just some uncertainty on the business side relative to, what these surveys are asking. And they're definitely asking questions around what they, project their jobs market, or what they project their expenses to be, and things like that, especially relative to the tariffs. We also have very negative sentiment in the stock market. So that is just, essentially the mood of investors. And that is it's what we call a contrarian indicator, meaning when fear is the highest, that's the best time to be buying. And I've got two different kind of charts or graphs here. This left one here is from CNN. They have the Fear and Greed Index, and they've been publishing again for quite some time. And it's, on the very edge there of extreme fear and fear. But over the past week and month, it's been kind of in that fear zone, in extreme fear zone. And then on the right, this is the University of Michigan Consumer Sentiment Survey. This is released every single month. And if you look here, so this average, this dotted line, I know there's a lot here on this graph. So 84.3, that's kind of the survey index value average. And this is going back to the 70s. And then you can see here, there's these blue dots, and they're at kind of low points of consumer sentiment. And then there's the date of when that happened, and then there's a plus for the most part on basically where all those blue dots are at after that. Well, that's the forward return 12 months after that point was reached. So February 1975, that was a low point for consumer sentiment. February 1976, the S&P 500 was up 22%. So 1 year post. So you can see, these are, again, contrarian indicators. Sentiment's bad, great, good time to be buying. Forward returns are very good when we're in situations like this. So let me talk through these kind of tariff scenarios. So where I believe we would see, the good tariff scenario, where the market would kind of revert back to the trend it's been on. We have that 10% kind of rest of world tariffs, and then the Chinese tariffs are reduced dramatically. On that previous chart I showed, they were at 145%. And what we would look at when things like that are announced, it's like, okay, well, there's the instant kind of market reaction, and then over time, well, how are businesses kind of handling that? Well, the ISM surveys would definitely be some things that we'd pay attention to. Of course, the jobs market, because we would see, hey, are companies able to handle these tariffs? And consumers too, are they able to handle the tariffs? These two are both the jobs market. Retail sales doesn't necessarily drop significantly either, meaning people aren't reducing their spending. And so, yeah, it's like there'd still be slower growth, but still positive which is a good thing. On more of a bad scenario, so let's say the tariffs are higher than 10% and or higher than what they were April 2nd, and then the tariffs on Chinese goods are reduced, but not necessarily as much as the market would like. Again, some data points would be, where does the ISM manufacturing surveys come in post? Because these things with the tariffs can happen, but then the rest that I have down here may not happen. And these are things that the market, is going to react to as well. I mean, the tariffs are going to be the headline. This is the economic data that's actually going to drive what's happening after the tariffs. It's just like when tax policy changes. Well, there's going to be, the headline comes out, or there's discussions of something changing, and then markets react if they think it's likely to happen, and it's whether good or bad. But then what actually shows up in the economic data over the next, several months to year is then what's going to drive the market over long periods of time. So that's why we're focused on the economic data. Yeah, the headlines are just going to be what they are, and the market's going to react based on the headline. What we're concerned about is then how do companies adapt and continue to generate the earnings that the market's expecting based on whatever the situation arises. And historically, the system here in the US has a good track record for companies being able to adapt. Like that's what happens. Companies figure it out. It's common to just think, well, this is just now going to change everything, and all these companies aren't going to be able to figure it out. I mean, it's possible, but highly unlikely. Companies will figure it out, and again, that's why the market moves forward. Certain sectors, yeah, definitely would get hit based on what these tariffs are on, and what impact that's going to have on their products. But that's basically, again, they're going to adapt. They're going to figure out how to, adjust their business lines and generate a profit. And then the ugly scenario is basically everything just kind of reverts to the highest it's been. On that graph where I showed those percentages, those were the peak amounts, and just nothing really changes on that. Now, a lot of the conversation has been, positive with, with the administration and some negotiation that's happening. But again, market's going to be very focused on this economic data here over the next several months. Because even if the tariffs are starting to get negotiated away, there might be a slight dip in some of the economic data because of what's been happening over the past month. Again, yeah, looking at in a scenario like this, I would expect that we'd start to see a spike in unemployment. And again, that's why we watch this data, because we look at that as, hey, do we need to make adjustments to the portfolio? And it doesn't mean, hey, we're gonna go all in to stocks when things are great, and we're gonna sell everything and move to cash when things are not. No, what it means is that we're gonna look at the makeup of the positions that we hold, and are there more defensive positions that we'd like to own, such as consumer staples and utilities, and healthcare stocks, companies that are less sensitive to a slowdown in the economic environment versus companies that are going to be more sensitive to that. Those are the things that we look at within the portfolio matrix to make adjustments. This again, this volatility isn't new. This is since World War II. All the bear markets, which is defined as the market dropping from a peak. So whatever that peak is, that can happen intra-year typically, and then down 20%. That's considered a bear market. This is the peak to trough. So when it peaked, when it finally stopped going down, what's the percentage drop, and then how long did that last? And then was this related to a recession or not? Because there's bear markets and there's no recession. That's what we saw in 2022. There was fears of recession, never happened. We haven't hit this bear market yet. May not. It was close, but you can see the different, on average, bear market, once it hits, down about 30%. Peak to trough lasts about 11 months. And then there's a period of time for it to recover. And, when we look at the data, that can be it can be on average about a year or two to recover back to the previous highs. And so that's why when we put portfolios together, one, we're diversified. So we're not just all in the S&P 500, which is what that displayed on that chart, but two, why we own bonds, money market, cash, things that aren't subject to the volatility of the stock market, so that we can continue to send people's distributions when things are volatile and we don't have to sell something at a bad time. Yeah, since World War II, there's been 25 times where the markets dropped between 10 and 20%, 7 times between 20 and 30%, 3 times between 30 and 40%, and then 3 times for 40% or worse. So let's just say 6 times between 30% or more. And again, this is going back to World War II, so quite a long period of time. And that's what, people are, yes, worried about those, but these happen on a very regular basis. If you look at that, that's every other year. The rest of these don't happen that often. And if you're diversified and you've got the right mix between stocks and bonds, and if you're pulling out distributions, you'll be fine. What this is looking at is when the markets have a 5% gain. So this happened back kind of in early April. And you tend to see this, like when you have big drops, you typically have big gains. Kind of they huddle around each other. They happen very close to each other. But since 1950, when the markets had a 5% gain in one day, what are the forward returns based on these different time frames here? And I'm more concerned about the 12-month period on the very end here. On average, forward returns after we've had a 5% gain day, 26%, the median, 21%, and the percent of the time that it's positive is 91%. And this coincides with the forward returns of the market multiple slide, where he said, yeah, there might be some volatility, but forward returns after the volatility picks up is significantly better on stocks. But it's common to want to just say, hey, let's just wait for things to calm down. Let's move everything to cash. And it's like, well, you start to have these quick recoveries, and all of a sudden it's like, well, headlines may not have been much better, but the market's looking ahead. It's looking forward. So just to recap here, yeah, our market multiple here based on current earnings. So if earnings, they change. They were slightly higher during our last presentation. They've come down. Analysts have adjusted their earnings based on current events, and based on these multiples, I believe we could see anywhere from 6% on a low end up to nearly 30% over the next 12 months based on the current value of the S&P 500. So, I think that, bodes well for stocks going forward. And, again, we'll be covering all of this in each of your annual reviews that are clients of the firm. We talk through the allocation and, distribution needs and things like that to make sure that you're not having to sell something at a bad time. And then, of course, talk through our projections based on your unique situation. Well, thank you all for attending today's webinar. Again, appreciate all the questions. For those that are less familiar with us, our website, keenwealthadvisors.com, if you go to the Retirement Resources tab, You can find our blog, podcast, and the webinar replays. So you can find the previous replays of my quarterly updates there alongside, you can request a copy of Mr. Keen's best-selling book, Keen on Retirement, Engineering the Second Half of Your Life. If you'd like a copy of that, happy to get one in the mail to you. You could send me an email, mwilson@keenwealthadvisors.com, or you could reply to any email that you receive from Keen Wealth and request a copy of the book. And then lastly, yes, along with the replays on our website, we also have them posted on our YouTube channel. Check that out. Keen, it's youtube.com/@Keen Wealth Advisors. Links are on our website, also on our email signatures too, to access that. Lots of great content on the YouTube channel. We actually are kind of putting some different content that's not available anywhere else besides the YouTube channel. Again, thank you all for again listening in today and submitting your questions, and we will get those questions, if we didn't cover them during today's webinar, get them answered and covered for you in a future podcast episode.